Hello students, welcome to today's episode. In this episode, we will discuss about risk and return. As we know, the most important objective of financial management is to maximize the wealth of the shareholders. This can be maximized by increasing the market price of their holdings. Market price of shares depends upon the risk and return characteristics of a financial decisions taken by a firm. So, a financial manager has to consider the two important determinants, that is risk and return, in his financial decision making. I am Dr. Arshia Hussain, PhD in Human Resource Management and teaching in the Department of Commerce and Business Studies, Jamia Millia Islamia University, New Delhi. So, we will first discuss the meaning of risk or risk management. Risk may be defined as the amount of volatility involved in a given investment. Return may be defined as the amount of money expected by the investors on a given project. Risk and returns are correlated. The greater the risk in an investment, the greater will be the return on that investment. And investors must be a risk taker in order to get high returns from the investment. In other words, return is the factor which motivates the investor to invest in the investment process. For an investor, the return from an investment is the expected cash inflows in the form of dividends, interest, bonus, capital gains, and so on, available to the holder of an investment. Now, the investment in equity shares gives returns to its shareholders in the form of dividends and the capital gains or losses at the time of sale of these shares. It may be represented in the following form. K is equal to P1 minus P0 plus D1 divided by P0, where K is equal to expected rate of return from the investment. P0 is equal to market price at time 0. P1 is market price at time 1 and D1 is equal to cash dividend for the period 1. Now, the equation reflects that the expected rate of return K is the combined effect of capital gain or loss, that is P1 minus P0, and the cash dividends, that is D1, over the period. The equation can be used to determine the rate of return of any investment. The time period in this equation has been taken as a year and therefore the value of K is the annual rate of return. Now, let's see an example on this. X company is evaluating the rate of return on two of its machineries, machinery 1 and machinery 2. The machinery 1 was purchased a year ago for rupees 4 lakhs and since then it has generated cash inflows of rupees 16,000. Presently, it can be sold for a price of rupees 4,30,000. Machinery 2 was purchased a few years ago and its market price in the beginning and at the end of the year was rupees 2,40,000 and rupees 2,36,000 respectively. Machinery 2 has generated cash inflows of rupees 34,000 during the year. Find out the rate of return on these two machineries. See the solution now. The rate of return on these assets can be calculated with the help of the following equation. The equation is K is equal to P1 minus P0 plus D1 divided by P0, which is equal to rupees 4,30,000 minus 4 lakhs plus 16,000 divided by 4 lakhs. So, for machinery 1, K is equal to 11.596 and for machinery 2, we have rupees 2,36,000 minus 2,40,000 plus 34,000 divided by rupees 2,40,000. So, thus the value of K is equal to 12.5%. Now, in this example, the rate of return of machinery 2 is higher at 12.5%, though its capital value has reduced from rupees 2,40,000 to rupees 2,36,000 over the period of time. Now, the reason for higher rate of return is the relatively higher cash inflows of rupees 34,000 from machinery 2 during the year. So, it is the combined effect of the change in value and the cash inflows that make up the rate of return on any asset or investment. The return from an investment during a given period is equal to the change in value of the investment plus any amount of income received from the investment. Now, any capital or revenue income from the investment to the investor must be included in returns to the investor, otherwise the measure of return will be deficient. Thus, total return is equal to yield plus price change. However, returns cannot be forecasted with certainty as there is always a risk involved that the cash inflows may not result as expected and also that the market price of the investment may fluctuate in either direction. Risk can be measured by specifying the probabilities associated with each of the possible future return. For example, an investor has identified 5 possible outcomes for his return during the next year. Now, the return associated with each investment is determined by a subjective probability or relative chance of occurrence. The 5 possible outcomes are as follows. Possible returns in one column and subjective probability we can see in the other column. So, possible returns we have 20%, 21%, 22%, 23% and 24%. Now, subjective probability for these possible returns are 0.15, then 0.20, then 0.50, then 0.20 and for 24% it is 0.05. Now, we can note that in the table the sum of the probabilities is 1. It means that the actual return is confined to take one of the 5 possible values. Now, given this distribution, the expected return from investment can be calculated with the help of the following equation. R is equal to sigma pi xi, where R is equal to expected return, P stands for probability of ith return, xi is equal to possible return and N is the number of years. Now, the equation here considers the average expected return R as the weighted average return of possible returns by taking the probabilities of these returns as weights. Now, consider this table. In the table, the calculation of expected return is shown to us. First column shows us percentage expected returns. In the second column, it is probability and then pi xi, which is the multiplication of the 2 columns, which is expected returns multiplied by probability. The expected returns in percentage is 20. Probability for the same is 0.15 and pi xi is 3. Then the second one is 21. The probability given to us is 0.10 and pi xi is 2.10. Then percentage expected returns is 22, then probability pi is 0.60, then pi xi is 13.20. Then 23, which is the next one is and the probability for this is 0.10 and pi xi is 2.30. Then the last percentage expected returns is 24 and probability for this is 0.05 and pi xi which is the multiplication of percentage expected returns multiplied by probability is 1.20. Now, summation of pi xi is equal to 21.80. So, therefore, expected return, that is R, is equal to 21.80. Now, average rate of return, we will see the rate of return can also be calculated for a period more than 1 year. The average rate of return represents the average of annual rates of return over a period of years. The formula used for calculation of average rate of return is given as R bar is equal to 1 upon n multiplied by R1 plus R2 plus Rn, or 1 divided by n multiplied by R1 plus R2 plus Rn, where R bar is equal to average rate of return, R1 plus R2 plus Rn is equal to annual rate of return in the period 1, 2 and 3, then n is the total number of periods. Now, we will see another example. The average market prices and dividend per share of Sigma Securities Limited for the past 6 years are given as. Now, the table for the example is given to us as years, then we have average market price and then we have dividend per share. Now, years we can see 2015 to 16. The average market price in the year 2015 to 16 is 68, then dividend per share is rupees 3. Average market price in the year 2014 to 15 is 61 and dividend per share is 2.6. Then average market price in the year 2013 to 14 is 50 and dividend per share is rupees 2. Then average market price in the year 2012 to 13 is 53 and dividend per share in the same year is 2.5. Then average market price in the year 2011 to 12 is 45 and dividend per share is 2.0. Then average market price in the year 2010 to 11 is rupees 38 and dividend per share for the same year is 1.8. Now, we have to calculate the average rate of return of Sigma Securities Limited share for past 6 years. Now, we can see the solution here. We have years given to us, average market price per share, then capital gain, then dividend per share and dividend yield in terms of percentage and rate of return, which is also in terms of percentage. Now, for the year 2010 to 11, it is 38. That is average market price share, capital gain is nothing, then dividend per share is 1.8 and dividend yield in terms of percentage is 4.7% and there is no rate of return in this year. Then in 2011 to 12, the average market price per share is 45, then capital gain on this is 18.42%, dividend per share is rupees 2, dividend yield is 4.44% and rate of return is 22.86%. Then in the year 2012 to 13, the average market price per share is rupees 53, capital gain on this is 17.78%, dividend per share is 2.5 rupees, dividend yield we have is 4.72% and rate of return is 22.50. Then for the year 2013 to 14, the average market price per share is 50 and capital gain is there is no capital gain, it is minus 5.66 and dividend per share is rupees 2, dividend yield is 4% and rate of return is minus 1.66%. Then in the year 2014 to 15, the average market price per share is rupees 61, capital gain we can see here is 22, then dividend per share is 2.6 rupees, dividend yield is 4.26% and then rate of return is 26.26%. Then finally, in the year 2015 to 16, average market price per share is rupees 68, capital gain we can see here is 11.48%, dividend per share is rupees 3, dividend yield is 4.41% and rate of return is 15.89%. Thus, we can find out R bar is equal to 1 divided by 5 multiplied by 22.86 plus 22.50 minus 1.66 plus 26.26 plus 15.89, which is equal to 1 upon 5 multiplied by 85.85, which is equal to 17.17%. So, that is the rate of return we have is the 7.17%. Now, we will discuss the concept of risk in detail. Risk basically in an investment implies that the future returns from that investment are unpredictable. Risk may be defined as the possibilities that the actual return may not be same as expected. Risk may be defined as the possibility that the actual outcome of a financial decision may not be same as estimated. In other words, the actual results or outcomes or returns may vary from the estimate. So, the risk may also be considered as a chance of variation or chance of a loss. Investment having greater chances of variations or chances of loss are considered as more risky than those with lesser chances of variations. There is a difference between risk and uncertainty. Risk is defined as a situation where the possibility of happening or non-happening of an event can be quantified and measured, while uncertainty is defined as a situation where this possibility of the occurrence of an event cannot be measured. Now, we will see the different kinds of risk. Risk can be classified into the following categories. First one is capital risk. It may be defined as the risk of incurring a capital loss due to downward changes in the market price of a security. Example of capital risk is investment in equity shares. Then the second type of risk is income risk. Now, it is a risk of variation in return available from the security. For instance, dividends paid by a company on equity shares may vary from one year to another. The third type of risk is default risk. Now, it is a risk when there is a default in payment of interest or repayment of the principal amount by the company. This risk may also include the risk of losing the principal amount of shares and debentures in case of winding up of the company. Now, the different types of securities offer different degrees of risk. For example, government bonds are considered as a riskless security as there is no risk of a default of any type on these bonds. The risk involved in corporate bonds is higher than the government bonds, as corporate bonds has both the default risk and the capital risk. Now, the equity share bears a high risk as the investor has a direct share in the risk of the firm. So, if an investor holds a government bond, he faces no uncertainty about the monetary outcome. The value of the bond at maturity will be same with the given value of the bond. So, in such a case, the investor bears no risk. Now, we will see measurement of risk. See, risk can be measured by finding out the range of possible returns, which is simply the difference between the highest and the lowest value of return. However, the most common, convenient and reliable measure is the degree of spread of possible returns away from the expected return. In other words, this is the standard deviation of possible outcomes, that is, standard deviation is equal to root of sigma pi into xi minus x bar the whole square. Now, the risk in the example can be measured by taking the range 4%, that is 24% minus 20%, or by finding out the standard deviation of the expected return R as given in the given table. This table shows calculation of a standard deviation of expected return. Returns given to us in one column, then probabilities, and then xi minus r the whole square, pi into xi minus r the whole square. So, returns are 20. Probabilities is 0.15, then xi minus r the whole square is 3.24, then pi into xi minus r the whole square is 0.486. The return 21, the probability given to us is 0.10, then xi minus r the whole square given to us is 0.64, and pi into xi minus r the whole square is 0.064. Then for 22, the probability is 0.60, then xi minus r the whole square 0.04 we have, then pi xi minus r the whole square, that is 0.024. Now, for return 23, the probability associated with it is 0.10, and xi minus r the whole square is 1.44, then pi xi minus r the whole square is again 0.144. Now, for the returns 24, the probability is 0.05, then xi minus r the whole square 4.84, then pi xi minus r the whole square is 0.242. Thus, the expected return I is equal to 21.8% as calculated in the table read just now. The standard deviation is root of 0.960, which is equal to 0.9798%. Now, in this case, the expected return from the investment is 21.8% with the range of 4% and the standard deviation of 0.9798%. 8. So, the investment may be termed as higher return with low variation investment. In the example, we are calculating expected return and standard deviation. Now, we can see returns, probabilities, pi xi, then xi minus r the whole square, pi xi minus r the whole square. Returns are given to us minus 20, minus 10, 10, 15, 20, 25, 30. Now, probabilities for these different returns are 0.05, 0.10, 0.20, 0.25, 0.20, 0.15 and 0.05. Then PIXI for the different returns and probabilities are minus 1, then again minus 1, then we can see 2, then it is 3.75, then it is 4, then 3.75, then again it is 1.50. Now, the column of xi minus r the whole square, which we can calculate on the basis of the PIXI, is 1089, then 529, then we have 9, then we have 4, then we have 49, then 144 and then 289. Then the last column, which is PIXI minus r the whole square, for the first return of minus 20 and probability of 0.05, we have 54.45, then the second one is 52.90, then 1.80, then 1, then we have 9.80, then 21.60, then 14.45. So, basically this is the column of pi into xi minus r the whole square, which is the multiplication of the two columns that we can see. Now, the summation of this PIXI, we will do summation and it comes out to be 13. Then for PI into xi minus r the whole square, the summation of this is 156. So, thus the expected return r bar is equal to 13% and the standard deviation is root of 156, which is equal to 12.49%. Now, in this case the expected return is relatively lower, but range of 50, that is 30 minus 20, as well as the standard deviation 12.49 are on the higher side, and therefore this investment may be called as a risky investment. We can consider one more example for better understanding. Another example we can see, Mr. Rathore invested in equity shares of Star Aluminium Limited. Its anticipated returns and associated probabilities are given as returns in one column we can see and probability. So, for returns minus 15%, 0.05, then for minus 10% it is 0.10, for 5% it is 0.15, then for 10% it is 0.25, for 15% it is 0.30, then for 20% it is 0.10, and finally for 30% return it is 0.05, the probability associated with it. We are required to calculate the expected rate of return and risk in terms of a standard deviation. Now, we can see the solution here in the form of the table. Here we have calculated expected return and risk in terms of a standard deviation. We can see the returns given to us, probability. Now, we have another column which is P into R, then the other column is R minus R bar, then R minus R bar the whole square and R minus R bar whole square multiplied by P. We can see the value, the first value, that is probability into return, is minus 0.75, then R minus R bar is minus 5.5, then R minus R bar the whole square is 30.25, then R minus R bar whole square into P is 1.5125. Similarly, for the next probability of 0.10 is P into R is minus 1, R minus R bar is minus 0.5, then R minus R bar the whole square is 0.25, then R minus R bar the whole square multiplied by P is 0.0250. Then the third one, that is 0.15 probability, we have 0.75, then minus 4.5, then 20.25, then 3.0375. Then for the probability 0.25 and returns 10%, we have P into R is 2.50, then R minus R bar is equal to 0.5, then R minus R bar the whole square is 0.25, then R minus R bar the whole square multiplied by P is 0.0625. As you can see, for 15 it is 4.50 is P into R, then 5.5 is R minus R bar, then 30.25 is R minus R bar the whole square, then 9.0750 which is R minus R bar the whole square multiplied by P. For the next we have 2, which is P into R, then 10.5 is R minus R bar, then 110.25 is R minus R bar the whole square, then R for the R minus R bar the whole square into P is 11.0250. Finally, for 30% return and probability 0.05, P into R is 1.50 and R minus R bar is 20.5, then R minus R bar the whole square is 420.25, and finally R minus R bar the whole square multiplied by P is 21.0125. So, the summation of R is equal to 9.5% and the summation of R minus R bar the whole square multiplied by P is equal to 45.75. Thus, we can see that expected return R is equal to sigma P multiplied by R, which is equal to 9.5%. Then standard deviation is equal to sigma R minus R bar the whole square multiplied by P, which is equal to root of 45.75, which is equal to 6.764. Thus, the risk can be measured by taking the range of 45%, that is 30% and minus 15%, and standard deviation of 6.764. The investment carries greater risk in terms of high variation. Now, we can see expected return and variability of return of investments. Let us consider this example for calculating expected return and variability of return of investments. Another example we can see, an investor is evaluating two securities alpha and beta in terms of their risk and return. The expected returns and standard deviations for both the investments are as follows. Expected return for alpha is 12% and for beta is 20%. Then standard deviation for alpha is 9 and for beta is 10. Now, what would be the advice to the investor? Now, we can see solution to this. In this case, the two assets being evaluated, that is alpha and beta, have different returns of 12% and 20% respectively. So, the measure of standard deviation is not sufficient to evaluate their risk. The standard deviation should be used only when the different investments have same expected rate of return. In this situation, we can measure risk by calculating coefficient of variation. The coefficient of variation of investment alpha is 9 divided by 12, which is equal to 0.75, and of investment beta is 10 divided by 20, which is equal to 0.50. So, the investment beta has lower coefficient of variation and therefore is considered as less risky than the investment alpha. It is important to note here that investment beta has higher standard deviation of 10%, but still it is less risky in terms of coefficient of variation. Now, we can see one more example, and in this example we will calculate coefficient of variation for comparing the risk. So, CV is better for comparison of risk factor. It is because it considers the relative size as well as the expected return. The larger the coefficient variation or the greater the possible dispersion of future realized values around the expected value and larger the investor's uncertainty and risk. A rational investor can make a decision of making investment out of various combinations of risk and return as shown to you in the table. We can see the table here: risk and return and investment decisions. High return, high risk, maybe, and low risk, definite. Then low return means no investment, and then maybe. Now, given the choice between two investment options, a risk-averse investor would prefer investment with higher returns and lower risk, that is, lower standard deviation. Now, out of two investment options having equal returns, the investor will opt for that investment which has relatively low risk. Further, if two investment options have same risk, then the investor will opt for that investment which has the higher return. Now, we will see types of investors. Investors may be classified on the basis of risk return perception. So, first type of investor we can see here is risk averse. Now, these are the investors who prefers to avoid risk. However, they may be ready to take risk if the return available for taking extra risk is adequate. Second type is risk seeker. These are the investors who are ready to take risk even if the return for taking that risk is not sufficient enough. The third type is risk neutrals. Now, these are the investors who require just a sufficient return for taking risk. They want neither extra return for a given risk nor are ready to take extra risk for a given return. Next is factors to be considered for selection of a portfolio. Now, selecting the right type of portfolio is a difficult task and requires a professional approach. Reviewing the portfolio in the light of risk and return factors is a necessity. An investor must be efficient and expert to determine the appropriate portfolio. However, various factors considered while deciding the portfolio are: the first one is liquidity and marketability of the portfolio. Now, the portfolio should be such that it provides liquidity whenever required. All the funds should not be invested in long-term securities. It is important that the security must have a marketability or buyback option. Second one is tax planning. The investor should plan the portfolio in such a way that it minimizes the tax liability. For example, interest income from certain investments such as deposits with commercial banks, cooperative banks and so on are allowed as deduction from taxable income under Section 80L of the Income Tax Act 1961. Dividends from a company are not taxable in the hands of the shareholders. Then third one is capital gains. The securities should provide capital gains in the long run. There are certain securities which provides lower returns in the short run but have a great potentiality of capital gains in the long run. So, these securities provide sufficient income in the long run and also provide a hedge against inflation. Minimization of risk. Now, while selecting a portfolio, an investor should consider the total risk of the portfolio rather than risk of any particular investment only. The investor should also make an attempt to minimize his total risk. If the portfolio consists of high risk securities, then the investor should not block additional funds in high risk security even if the expected return is higher. One more point is there, which is industry diversification. An efficient portfolio should consist of investment made in different industries of diverse nature. It saves investor during the period of recession. So, that is all for today. Hope you have understood the topic of risk and return. We'll meet in the next episode. Till then, take care. Goodbye.